If you walk into your kitchen right now, I mean literally right now, and open the pantry or the freezer, I would bet good money you're going to find Conagra Brands.
Oh, absolutely. We're talking Hunt's tomatoes, Bird's Eye veggies, Slim Jims.
Maybe a healthy choice meal or two.
No.
They're everywhere.
They're kind of the invisible giant. You don't always realize it's one company behind all these different products, but they are just omnipresent.
Invisible on the shelf, sure, because of all the brand names. But if you look at the stock market, they are very, very visible for all the wrong reasons.
It's a classic fallen giant scenario. This absolute titan of the food industry is trading at multi-year lows.
Which is wild, but what makes this so interesting right now isn't just that the stock is down, it's the weird math that happens when a stock like this falls so far.
You're talking about the dividend yield.
Exactly. Because the price has dropped so much, the dividend yield has shot up to over 8%.
Which is unheard of for a boring food company. 8% is what you expect from, some risky financial asset, not canned chili.
Right. And that's the real tension we're unpacking today. Is this 8% yield a golden opportunity to buy a turnaround story on the cheap? Or is it what investors call a value trap?
A company that looks cheap, but is actually in a death spiral.
Exactly. So we've got a huge stack of sources here. The Q2 fiscal 2026 earnings transcripts, investor decks, analyst reports from Seeking Alpha, some industry news on food labeling.
And what emerges from all this is a picture of a company trying to do three very difficult, very expensive things all at the same time.
It feels like they're trying to turn an ocean liner around in a bathtub.
They're splitting how they manage their brands. They're betting the farm on this new AI thing called Project Catalyst. And they're pivoting hard to chase the weight loss drug trend.
Okay, so let's get into it. This is the deep dive on Conagra's fiscal 2026.
Let's do it.
I want to start with that strategy shift because reading the transcripts, it feels really drastic. Management kept using this term bifurcation of their portfolio. It sounds like corporate speak. What does it actually mean?
It's basically them admitting that the old way of running a food conglomerate is, it's dead. You can't treat every single brand the same way anymore.
So you can't treat a can of tomatoes like a bag of artisanal popcorn.
Exactly. So Conagra split their entire portfolio into two distinct buckets, growth and cash. And they're running them with completely different, almost opposing playbooks.
Okay, break that down. Let's start with the growth bucket. What brands are in there?
This is the heavy artillery. It's mostly their refrigerated and frozen segment, so that's pulling in about $1.3 billion in revenue a quarter.
So that's your Bird's Eye, your healthy choice banquet.
Right. And then you have the snacking side of things. Slim Jim, Angie's Boom Chicka Pop. All told, this growth bucket is about 70% of their retail business.
So this is the fun stuff, the stuff you grab for a quick lunch or a movie. What's the playbook here?
Well, the core financial strategy is what they call investing margin.
Investing margin. Translate that for me.
It means they are deliberately choosing not to raise prices, even though their own costs are going up.
Wait, really? For the last few years, all we've heard is inflation, 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 companies raising prices just because they could.
And that's why this is such a hard pivot. They realized consumers just hit a breaking point,
Yeah.
People were walking away. They were trading down to store brands or just cooking from scratch.
So Conagra's saying, fine, we'll eat the cost. We'll take the hit on our profit margin just to get the volume back.
It's a volume play, pure and simple. They are betting on market share over immediate profit. They just need people to put that healthy choice bowl back in the cart.
Is it actually working? Or are they just burning cash?
Well, according to the Q2 data, the volume part of it seems to be working. The snacking business had its fourth straight quarter of sales growth.
Okay, that's a good sign.
And in frozen single-serve meals, they've regained a lot of market share. They hit something like a 53% share in that category.
So people are buying the frozen meals again because the price is right.
Right. They stopped the bleeding, at least on that front.
But you said there was a second bucket. The cash brands. I'm guessing this is where Hunt's ketchup and Vlasic pickles live.
You got it. This is the staples bucket. Canned goods, shelf-stable items, Hunt's, Vlasic, Wolf brand chili, Swiss Miss. The strategy here is the exact opposite. They call it inflation-justified pricing.
Which is a very polite way of saying we're raising the prices.
Precisely. They know if they raise prices on pickles, people will buy less. They fully accept that the volume will drop. They're kind of managing these brands for a slow decline.
That sounds grim. Why would you manage a brand for decline?
Because the goal here isn't growth, it's cash extraction. They want to squeeze every last cent of profit out of Vlasic and Wolf brand chili and treat them like a piggy bank.
A piggy bank for what?
to pay down their massive debt and to fund the marketing for the growth brands, like Slim Jim.
It's a Robin Hood strategy. Take from the pickles to feed the pepperoni.
That's a great way to put it, and they're serious about it. To make this work, they also had to trim the fat, right? They sold off some big names.
Yeah, I saw that. Chef Boyardee, that's a childhood staple gone.
It is. They divested Chef Boyardee in their frozen fish business. So, Band of Camps and Mrs. Paul's brought in about $643 million from that sale.
But why those specifically?
They were kind of stuck in the middle, not growing fast enough to be a growth brand, but too complex to just be a cash brand. So they sold them off to pay down debt and simplify everything.
It shows how serious they are. They're cutting the nostalgia to focus on where the modern eater is spending money, which, speaking of, leads us right to the second big theme, the Ozempic effect.
This part is fascinating.
We keep hearing about these GLP-1 weight loss drugs, and the story is always that they're bad for food companies because people just stop eating. So how does a company known for frozen mac and cheese pivot to that?
This is where the marketing team really earns its paycheck. Conagra got USDA approval to put GLP-1 friendly labels on 26 different healthy choice meals.
GLP-1 friendly, is that an official medical term? Did the FDA sign off on that?
Absolutely not, and that's a crucial distinction. The experts in our sources all point out there is no FDA standard for GLP-1 friendly. It is purely a marketing term.
So what does it even mean?
The USDA approved it because the label is really just highlighting that the meal is high in protein and fiber.
Which, to be fair, is what people on these drugs are looking for, right? Their appetites are suppressed, so every bite has to count.
Exactly. If you can only eat 1,200 calories a day, you can't waste them on empty sugar. You need nutrient density. So Conagra is just signaling, hey, if you can only eat a little, eat this.
My skepticism here is that the number of people on these drugs is still pretty small. Are they really pivoting a whole product line for like 5% of the population?
That's what I thought too. But here's this surprising stat from the reports. 77% of the sales for these GLP-1 friendly meals are coming from households that are not using the drugs.
Really? So it's just working as a general healthy label?
It's the gluten-free phenomenon all over again. People buy gluten-free even if they aren't celiac because they think it's healthier. GLP-1 friendly is just becoming code for high-protein, science-backed nutrition.
It signals nutrient dense. And that ties into the broader trend they're betting on, which is protein. Their Future of Frozen Food report said it's a $12 billion driver.
It is the #1 nutrient people look for. And they are leaning in hard. They have these banquet mega bowls now. There's one that's a Mike's Hot Honey Chicken Mac and Cheese.
That does not sound GLP-1 friendly.
Definitely not. But it is very protein heavy. They've also got a collaboration between Slim Jim and Buffalo Wild Wings. It's all about high protein, bold flavors.
And to make all that chicken, they made a big operational move too, didn't they? The chicken strategy.
Yes, and this connects back to the margin pressure we talked about. For years, Conagra outsourced their chicken production. They paid another company to bake it, then bought it back to put in their bowls.
Which is fine when chicken is cheap.
But with demand soaring, that middleman cost was eating them alive. So they repatriated it. They brought baked chicken production in-house.
Bringing the chicken home.
It sounds funny, but it's critical for long-term margin control. If you control the factory, you control the profit.
Okay, so we've got the bifurcation strategy, the protein pivot. But the thing that really caught my eye was something called Project Catalyst. It sounds more Silicon Valley than frozen food aisle.
Yeah, launched just recently in January 2026. This is their massive AI and data automation initiative.
I have to be honest, I feel like every company says they're doing AI now. Is this just buzzwords to pump the stock?
It's easy to be cynical, but the CEO was surprisingly blunt about why they need this. He admitted that Conagra's core business processes have been, and I'm quoting here, heavily manual for the better part of a century.
Ouch. So we're talking spreadsheets and clipboards?
Probably. And in a business with razor-thin margins, being manual is expensive. It means you're slow. Project Catalyst isn't about AI writing marketing jingles. It's about re-engineering the boring stuff forecasting, supply chain logistics, production lines.
Okay, so give me an example. How does AI help a frozen pea factory?
Think about forecasting. If you overestimate demand for a frozen meal, you have to pay to store it in a deep freeze warehouse. That energy cost is huge. If you underestimate, you miss sales. AI can analyze all this data to predict exactly how many peas to order so you don't waste money.
So the payoff is margin expansion.
Exactly. Their operating margins are stuck around 11.3%. If AI can make their forecasting just a little bit better or reduce waste by a fraction, that drops straight to the bottom line. It's the unsexy side of AI.
It's operational hygiene.
Right. But and there's always a but. We have to look at the scoreboard. The Q2 fiscal 2026 numbers, frankly, they looked a little ugly.
They were rough. Net sales down almost 7%, organic sales down 3%.
But the number that really hurts is the adjusted operating margin. It fell 406 basis points down to 11.3%.
400 basis points. That's a 4% drop in profitability in 1 year. Is that all just them investing margin, or is there more to it?
That's the main driver, but there were other headwinds. They're still facing about 7% gross inflation.
7%? That seems really high.
It is, and it's from two specific things. One is protein beef, and pork prices are at historic highs. So the cost of a Slim Jim is up, but they aren't raising the price. That's your margin drop right there.
And the second thing?
Steel tariffs. Think about the cash brands. Canned tomatoes, canned chili. The cost of the can itself has gone up. It's a double whammy.
And there was another huge red flag in the financials, a nearly $1 billion non-cash impairment charge.
Yeah, that's the one that grabs headlines.
Billion with a B. What does that mean in plain English?
It's an accounting admission of failure. Basically, they're saying these brands simply aren't worth what we said they were worth on our balance sheet.
That stings. It's like admitting you overpaid for a house and now it's underwater.
Exactly. It doesn't take cash out of the bank today, but it signals that the market doesn't believe in the long-term value of those assets.
And on top of all that, I read something about their flour business, Ardent Mills.
Ardent Mills. It's their joint venture in flour milling. Usually it's a steady profit driver. They expected about $200 million from it, but now it's looking more like $170 million.
So a $30 million hole. Why?
It's ironic, actually. The wheat market has been too stable.
Too stable? I thought stability was good.
Not for a trader. Ardent Mills makes money on volatility, buying low, selling high. When the market is flat, those trading opportunities just disappear.
So they're catching no breaks. And don't forget the debt.
About $7.6 billion in net debt, a leverage ratio of 3.83x.
Is that panic level?
It's not panic, but it's uncomfortable. You want that number closer to 3x. Being near 4x means a lot of your cash just goes to interest payments.
Okay, so let's recap. We have falling sales, crunched margins, high debt, a $1 billion write-down, and guidance for EPS of just, what, $1.70 to $1.85? It sounds like a disaster.
It does. Yeah. But then you have that 8% dividend yield.
And that brings us to the year trap question. Why would anyone buy this? Walk me through the bull case.
The bull case is that the stock is priced for a disaster that just isn't coming. It's trading at a PE ratio of about 9.6x. That is dirt cheap.
If you believe the turnaround is real.
Right. The bull says, look, the volume strategy is working, market share is up, Project Catalyst is going to cut costs, the chicken strategy will fix margins by 2027. Basically, 2026 is the bottom.
So you buy now, you get paid an 8% dividend to sit and wait for the stock to bounce back.
Exactly. You collect that check while management fixes the plumbing.
Okay, now give me the bear case. Why is this a trap?
The bear says the fundamentals are deteriorating now. Free cash flow was negative last quarter.
Meaning they spent more cash than they brought in.
Yes. And that 8% dividend cost real money. If you're not generating cash, how sustainable is that payout? The bear argues they're destroying profitability to chase volume, and there's no guarantee the margins ever come back.
And management is calling 2026 a bridge year.
Which is Wall Street code for don't expect anything good for 12 months. You have to just trust that growth will return. Yeah. One analyst we rated a clear sell, saying the turnaround relies on execution that hasn't happened yet.
It's a trust exercise.
It really is. And with that much debt, if they have another bad quarter, that dividend might be the first thing to get cut.
And if the dividend gets cut, the stock price crashes. That's the nightmare.
Yep.
So let's bring this all together. You've got this legacy giant, Conagra, trying to digitize a manual past with Project Catalyst, chase the modern diet with protein, and sacrifice profit today to keep customers loyal for tomorrow.
It's a textbook case of corporate trade-offs. You want high margins and high volume. Conagra has realized in this economy they can't have both. So they're choosing volume and just hoping AI and efficiency will fix the margins later.
It's a bold bet. And for you, the listener, especially if you're looking at that high dividend yield, here's the final thought I want to leave you with.
Go for it.
We know they had negative free cash flow. We know they are investing margin, losing profit on purpose. So how long can Conagra afford to pay you 8% to wait for their AI revolution to kick in? Is that yield the reward for being smart and buying at the bottom? Or is it the bait on the hook?
That is the billion-dollar question.
Thanks for diving in with us. We'll see you on the next one.
Take care.